This is GTC, Trade, Markets, Geopolitics. Today's global oil market is facing renewed uncertainty as Venezuelan oil, U.S. policy decisions, and geopolitical power shifts collide once again. Recent actions by the United States are reshaping expectations around Venezuelan crude exports, triggering reactions across energy markets, from China to Russia. In this in depth analysis, we break down what's happening, why it matters, and how it could redefine global oil flows, prices, and power balances in the months ahead. Venezuela, from oil giant to sanctioned producer. Venezuela sits on the largest proven oil reserves in the world, surpassing even Saudi Arabia. For decades, the country was a cornerstone of global energy supply and a founding member of OPEC. At its peak, Venezuela produced more than 3 million barrels per day, exporting oil across the Americas, Europe, and Asia. However, years of mismanagement, underinvestment, political instability, and international sanctions dramatically reduced output. Production collapsed to historic lows, infrastructure deteriorated, and skilled labor fled the industry. Despite these challenges, Venezuelan oil never disappeared from global relevance. Heavy crude from the Orinoco Belt remains strategically valuable, especially in a world where spare capacity is limited and demand remains resilient. Even modest increases or decreases in Venezuelan supply can influence market sentiment, price volatility, and geopolitical calculations. U.S. sanctions on Venezuela were initially designed to pressure the government by restricting access to global energy markets, financial systems, and investment capital. Over time, these measures became one of Washington's most powerful geopolitical levers in Latin America. Recently, the United States has signaled a tougher stance on Venezuelan crude exports, tightening enforcement and reassessing previously granted licenses. These actions do not necessarily eliminate Venezuelan oil from the market, but they reshape where it flows, how it is priced, and who controls it. From a market perspective, the message is clear. Venezuelan supply is politically conditional. This uncertainty alone adds a risk premium to oil prices. Traders price not only physical barrels, but also political intentions, diplomatic signals, and enforcement credibility. In theory, Venezuela's current production, estimated at under 1 million barrels per day, may seem marginal in a global market exceeding 100 million barrels daily. In reality, oil markets operate on margins, not totals. Spare capacity is concentrated in very few countries. Any disruption, delay, or redirection of supply tightens balances, especially during periods of strong demand or geopolitical stress. Venezuelan crude is also heavy and sour, meaning it is not easily replaced by lighter alternatives without refinery adjustments. This makes its availability particularly important for certain regions and buyers. As a result, U.S. actions on Venezuelan oil resonate far beyond Latin America. Oil markets respond instantly to geopolitical signals. When news breaks of tighter U.S. controls or reduced Venezuelan exports, futures markets often react with price spikes, even before any physical disruption occurs. This is because traders anticipate tighter global supply, increased competition for alternative barrels, higher transport and compliance costs, rising geopolitical risk premiums, volatility increases, speculative positions grow, and hedging activity intensifies. In short, oil becomes more expensive not just because of barrels lost, but because of confidence lost. China plays a critical role in the Venezuelan oil equation. As the world's largest crude importer, China has developed extensive experience in purchasing oil under complex geopolitical conditions. Discounted barrels from sanctioned producers fit well into Beijing's long-term energy security strategy. When Western buyers reduce exposure, Chinese refiners often step in, sometimes directly, sometimes through intermediaries. Payments, shipping, and insurance structures are adapted to minimize sanctions risk. For China, Venezuelan oil represents supply diversification, price leverage, strategic independence from Western systems. This dynamic strengthens China's influence in global energy markets while gradually weakening the effectiveness of unilateral sanctions. Russia's position in this landscape is unique. Although Russia and Venezuela are distinct producers, their situations intersect through market competition and sanctions dynamics. When Venezuelan oil faces restrictions, Alternative supply tightens Asian buyers, compete more aggressively. Russian crude gains pricing power. The story of Venezuelan oil is not just about barrels and refineries, it is about power, leverage, and global alignment. US reshapes supply expectations. China adapts and absorbs. Russia gains indirect advantage.